Welcome everyone to the May edition of the Shaw & Partners monthly video update, and as ever, no shortage of material to cover in yet another eventful month. As we record this, the Middle East conflict is ongoing, although it does feel like we're closer to a resolution of sorts than we have been previously. But as you know, we can't take anything for granted. Now, we've had a little bit more than 2 months of disruption in the movement of freight through the Straits of Hormuz, and as we said, duration was always going to be the determinant of the potential impact. But look, before we talk about that in more detail, let's have a look at how markets have fared over April. And the market story is quite different from the one that I gave 1 month ago. And share market returns tell that story very effectively. The benchmark, US benchmark, S&P 500 returned over 10% in April, and the Nasdaq bounced back a staggering 15.7%. European markets also rallied, although to a lesser degree, and emerging markets posted a very strong 13.3% lift. So altogether, the global all-world index posted a very strong 9.4% return. Now, those returns are all in local currency terms. The New Zealand dollar strengthened over the month, so New Zealand dollar returns were slightly lower. But it was a pretty special month for most share markets. However, Australasian markets weren't quite as buoyant. The NZX 50 was pretty much flat over the month, while the Australian market lifted 2.2%. What these returns are effectively describing is a sharp risk-on rebound over the month, and that was reversing the geopolitically driven sell-off that we saw in March. So global equities delivered one of their strongest monthly gains in several years. And look, you may well ask why, because it was a pretty resilient outcome given the continued tensions in the Middle East, but concerns over those tensions were absolutely swamped by improved investor sentiment, optimism over a resolution to the conflict, and a robust corporate earnings season, with investors effectively looking through the near-term geopolitical factors. And very prominent amongst the factors behind that sharp rebound was the market very much applauding US Q1 earnings results, and in particular, the levels of earnings growth coming out of those results. So far, and the earnings season hasn't finished yet, but from companies that have reported, earnings growth is just over 27% year on year. I really want to stress this is a very robust result, and if that holds, it will be the highest earnings growth rate year on year reported by the S&P 500 index since the last quarter of 2021. And that's really propelled US indices up into, in some cases, record highs. Now, after a showcase 2025, you've got growth in technology stocks. They've been more subdued so far in 2026, but April saw them push back into that leadership we saw in 2025. You had semiconductor names, hyperscalers, they led gains with significant outperformance across both developed and emerging markets for companies linked to the AI supply chain. So share markets had a great return, and that should be reflected in investment portfolio performances. Now, there wasn't a lot of movement in interest rates over the month. There are still, however, lingering concerns around the inflationary impact of the elevated oil price as those higher energy prices sort of work their way through supply chains. The real mover, of course, the one we're all looking at, has been the oil price, and the April price action was quite volatile. At one stage, the Brent crude contract peaked over $125 a barrel, but as we record this, the price has fallen to around $100 a barrel. But I do feel compelled to make the cautionary observation that despite promising signs that some form of agreement may be reached between the US and Iran, the test of whether the conflict has been resolved, being how many ships are actually moving with freight through the Straits, tells us that it isn't over yet. Now, last month, I reflected on the fact that from an investment point of view, we just have to deal with the cards as they fall. And right now, we need to think about that aftermath. Now, our base case scenario when we spoke last month was that the conflict would have been resolved by now. And that assessment was based on our view that the Trump administration does not want an extended war. It's not good economically or politically for the incumbent administration. And we warned about the impact of extended duration on things like consumer confidence and consumer spending. And we've certainly seen evidence of that in the local economy, less so in the US. Those impacts were very evident in local economic announcements over April. We saw a hefty fall in the level of business confidence in New Zealand in the ANZ Business Outlook, and some evidence of actual activity being deferred. But at this stage, the real casualty is forward-looking. It's not reflected in actual activity yet. The RBNZ, the central bank, left the official cash rate at 2.25%, but at their review, they adopted a slightly more hawkish stance. So they signalled a readiness to tighten policy if inflation expectations lift or they see wage growth accelerating. And they highlighted that Middle East developments had materially altered the inflation outlook. So it's lifted near-term inflation risks while weakening growth. Now, that's a bad combination. We call it stagflation. Updated forecasts signalled inflation could rise towards 4.2% in the June quarter. That's pretty high, with the committee emphasising it would act decisively if medium-term inflation expectations become unanchored. And on that vein, we also saw the release of inflation for the first quarter of the year. Now, headline CPI rose 0.9% in the March 2026 quarter. That makes inflation, annual inflation, at 3.1%. It was above expectations, and it's right at the top of the RBNZ target band. The labour market, though, has held steady. Unemployment improved slightly to 5.3%, but the second quarter numbers are going to be a better measure of the impact of the conflict on employers and on the labour market. So with all that in the background, how do you react from an investment perspective? Well, we are continuing to hold our current strategic asset allocation position. Now, in the period of time leading up to the commencement of the conflict, we had reduced the term aspect of our fixed interest exposure. Now, the market refers to this as the duration of interest rate exposure. That served us well because long-term interest rates have risen. We were looking for opportunities that might arise with certain sectors or markets being repriced to more attractive levels. Now, emerging markets was an example of that, and we have selectively increased or introduced exposure to emerging markets. I also continue to reiterate that uncertainty is the most apt description of the current environment. And in these situations, sometimes simply maintaining an invested position without any big bets is the most prudent approach. Your approach has also got to be well diversified as far as portfolio construction is concerned. You've got to be attentive to monitoring that, and you've got to be prepared to react once we believe an outcome is more certain. And it seems even more important with this degree of uncertainty to consider seeking guidance in how to participate in financial markets. It's got to be consistent with your long-term investment objectives and your risk tolerances. So, why don't you get in touch with us? We can help you navigate the financial markets and, importantly, retain a focus on the long-term perspective. And we'll bring our decades of experience to assist you in providing for your financial future. So if you want to know a little more, you can look us up on shoreandpartners.co.nz or on Facebook or LinkedIn. We'd always love to hear from you.